Most people think money laundering is a crime committed by criminals. And that's true, but only at the bottom, because something strange happens as you move higher through the system. The money gets cleaner, the people involved become more respectable, and the punishments almost disappear. In 2012, the US Department of Justice found that HSBC had laundered $881 million with the Sinaloa cartel, one of the most violent trafficking organizations on earth. Not one single executive went to prison. The bank paid a fine worth roughly 5 weeks of profit and carried on as if nothing had happened. That should raise an uncomfortable question. If one of the world's biggest banks can help move cartel money and nobody is jailed, then who actually gets punished for money laundering? The answer is that money laundering isn't one crime. It's a ladder, and every step higher changes who handles the money, how invisible it becomes, and how likely anyone is to face consequences. In this video, we're climbing all 5 levels. By the end, you'll understand why the people handling the smallest amounts of dirty money often receive the harshest punishments, while the people moving billions can walk away with little more than a fine. So let us start at the beginning. The first problem that every criminal organization faces, whether it is a street gang in Baltimore or a cartel operating across a dozen countries, is a problem that sounds almost mundane until you think about it carefully. The problem is physical cash. $1 million in $20 bills weighs approximately 50 kilograms and takes up the volume of a large suitcase. Pablo Escobar, at the height of his operation, was generating so much cash that he reportedly wrote off 10% of his annual revenue simply because rats ate the bills in the warehouses where he was storing them. The Sinaloa cartel has described buying rubber bands by the ton just to bundle bills. The sheer physical reality of large-scale criminal revenue is a logistical nightmare before you have even thought about how to spend it. And spending it is the whole problem, because the moment you try to deposit large amounts of cash into a bank, alarms go off. In the United States, banks are legally required to file a currency transaction report for any cash deposit over $10,000. So if you walk into a bank with $12,000 in cash, you have just created a federal document with your name on it. This is where level 1 laundering begins, and the primary technique at this level is called smurfing. Smurfing, also known as structuring, is exactly what it sounds like. Instead of depositing $12,000 in one transaction, you recruit a network of people, your smurfs, to each deposit smaller amounts at different banks on different days. $9,000 here, $8,000 there, $7,000 at a different branch. All of it never triggers a reporting requirement. All of it collectively moves the cash into the system. Think about what this requires in practice. If you are moving $1 million through smurfing at an average deposit of $8,000 per transaction, you need 125 separate transactions at multiple banks with multiple individuals. You need a network of people willing to do this. You need to pay them. You need to manage the logistics. And you need all of this to happen without any of those people talking to law enforcement. The other primary technique at level 1 is the cash-intensive business. Car washes, nail salons, restaurants, laundromats, parking lots, vending machine routes. These are businesses that legitimately receive large amounts of cash and have no fixed inventory that can be audited against revenue. If your car wash claims to have washed 4,000 cars this month at $20 each, that's $80,000 in reported revenue. The actual number of cars doesn't matter if the records are managed correctly. But here's the thing about level 1 laundering. It is the most dangerous stage of the entire process. This is where most arrests happen. Smurfers get caught because bank tellers notice patterns. Cash businesses get flagged because their revenue doesn't match their physical capacity. And at level 1, you are the most exposed, the most visible, and the least replaceable. The organization above you will sacrifice you without hesitation if it means protecting the money moving through the higher levels. Level 1 is where the street-level operators live, and it's also where the prison sentences are longest relative to the amount of money actually involved, because the people running this level have the least institutional protection of anyone in the entire chain. Level 2 is where the money stops being a physical object and becomes a legal fiction. Once criminal cash has been placed into the financial system through level 1 techniques, the next challenge is making it impossible to trace back to its origin. This is called layering. And the primary vehicle at this level is the shell company cascade. A shell company is a legal entity, a corporation or LLC, that exists on paper but conducts no real business activity. It has a registered address, a name, and in most jurisdictions, a director listed on file. What it does not have is employees, operations, or any meaningful economic activity. It exists for one purpose: to hold assets or move money in a way that obscures who ultimately controls it. Now here is where it gets interesting. A single shell company provides some concealment, but a cascade of shell companies across multiple jurisdictions provides something close to legal invisibility. Imagine this chain. Company A is registered in Delaware, where corporate formation costs less than $200, and the state does not require disclosure of the actual owner. Company A owns Company B, registered in the British Virgin Islands, where nominee directors, people paid to appear as the company's leadership on paper, are a standard and completely legal service. Company C owns Company D, registered in Panama, where banking secrecy laws prevent disclosure of account holders to foreign authorities. Company D holds an account in Luxembourg, which is used to wire funds to a real estate investment vehicle in London. By the time money moves through that chain, connecting the original criminal revenue to the London investment requires a law enforcement agency to successfully obtain records from 4 separate jurisdictions, each with its own disclosure laws, its own political relationships, and its own timeline for cooperating with foreign investigators. In practice, most investigations stop at layer 2 or 3 because the legal process of obtaining records from the next jurisdiction takes longer than the statute of limitations allows. This is not a theoretical scenario. In 2016, the Panama Papers leaked 11.5 million documents from a single law firm called Mossack Fonseca that had been setting up shell company structures for clients since 1977. The documents revealed 214,000 shell companies connected to clients in 200 countries. The clients included heads of state, intelligence officials, celebrities, and criminal organizations. Mossack Fonseca did not consider itself a criminal enterprise. It considered itself a legal services provider because forming shell companies is, in almost every jurisdiction involved, completely legal. And this is the thing about level 2 that most people do not understand. The cascade itself is not a crime. The companies are real legal entities. The transactions between them are real transactions. The lawyers and accountants and company formation agents who build these structures are licensed professionals operating within the laws of their jurisdictions. The crime is in the origin of the money flowing through the structure, and the structure is specifically designed so that no individual node in the chain has visibility into the full picture. By level 2, the money has already begun to forget where it came from. Level 3 is real estate. And real estate is where money laundering stops being a niche criminal technique and starts being an architectural feature of the cities you actually live in. Here is why real estate is the single most efficient money laundering vehicle ever devised. Property transactions are large, which means a single purchase can absorb enormous amounts of money in one move, rather than requiring hundreds of smaller transactions. Property values are subjective, which means the price paid for any given property is difficult to challenge on objective grounds. And historically, in most major jurisdictions, the disclosure requirements for real estate purchases have been almost non-existent. You could buy a $20 million apartment in Manhattan through a shell company without ever revealing who actually owned it. Think about what that meant in practice. In the years following the 2008 financial crisis, luxury real estate markets in cities like Miami, Vancouver, London, and New York were flooded with all-cash buyers. Investigators noticed something. A significant proportion of the most expensive purchases were being made not by individuals, but by limited liability companies. The LLCs had names that told you nothing. Their registered addresses were often the offices of the law firms that set them up, and the actual human beings who owned them were not disclosed anywhere in the public record. A 2015 investigation by the New York Times found that in the Time Warner Center in Manhattan, 50% of units worth $5 million or more were owned by shell companies. Among the actual owners eventually identified were people connected to fraud investigations in Colombia, a former prime minister convicted of corruption, and multiple individuals under investigation for laundering in their home countries. The building had a doorman and a concierge, and a rooftop gym. It also functioned as an unregulated bank for criminal capital. But the mechanics go further than simply buying property through a shell company. There are 3 specific techniques that operate at this level. The first is the renovation flip. You purchase a property through a shell company using criminal funds. You renovate it using legitimate licensed contractors paid at normal rates. You sell it at market value. The difference between your purchase price and your sale price is now completely clean capital because it looks exactly like the profit from a legitimate property investment. Criminal money has been converted into clean money through nothing more complicated than a kitchen remodel and a sale. The second is the rental cycle. You own a property through a shell company. You operate a separate, legitimate business in a different entity. That business rents space in your property at market rate. The rent payments are legitimate business expenses for the operating company and legitimate rental income for the property holding shell. Criminal money enters the property vehicle through opaque channels. Clean rental income exits. The third is value manipulation. You buy a property for $8 million when its actual market value is $5 million. The seller receives $3 million in clean funds above market price. That $3 million, previously criminal cash, is now been legitimately received as the proceeds of a property sale. The buyer has overpaid, but if the buyer is a criminal organization, overpaying for a clean transaction is simply the cost of doing business. The cities most deeply compromised by this are not random. They are specifically the cities that combine political stability, strong property rights, high transaction volumes, and historically weak disclosure requirements. London, Vancouver, Miami, Dubai, Singapore, Sydney. These are not failing states with corrupt governments. They are some of the most respected financial and residential markets in the world, and that respectability is precisely what makes them attractive. Criminal money does not want to hide in places that look corrupt. It wants to hide in places that look clean. Level 4 is where we have to talk about something that most documentaries about money laundering never address directly, because by level 4, the most important people in the operation are not criminals. They are professionals, and most of what they do is legal. The professional enabler ecosystem is the infrastructure that makes levels 2 and 3 possible at scale. It consists of 4 primary categories: lawyers, accountants, company formation agents, and real estate professionals, and each brings something specific to the architecture. Lawyers bring 2 things. First, they bring expertise in the precise structures that provide maximum concealment within legal bounds, the specific combination of jurisdiction, entity type, and ownership structure that makes tracing most difficult. Second, and more importantly, they bring attorney-client privilege. In most common law jurisdictions, a lawyer cannot be compelled to disclose information about a client's affairs, even to law enforcement, without a court order. This means a lawyer who structures a shell company cascade for a client can in many circumstances legally refuse to reveal who the client was or what the structure was used for. Accountants bring something different: the ability to create financial records that look exactly like legitimate business activity. The accounts of a shell company holding real estate, if prepared by a qualified accountant, will show income, expenses, depreciation, and tax filings indistinguishable from those of a legitimate property investment company. The numbers tell a story, and a skilled accountant can make that story say almost anything while remaining technically accurate about every single entry. Company formation agents are perhaps the least discussed but most operationally critical part of the ecosystem. These are firms, many of them completely legitimate businesses, that specialize in setting up corporate entities across multiple jurisdictions. For fees ranging from a few hundred to a few $1,000s, they will incorporate a company, provide nominee directors, open a bank account, and manage ongoing compliance filings. They process hundreds or thousands of clients annually. In most jurisdictions, they are not required to verify the ultimate purpose for which the companies they form will be used. The Mossack Fonseca documents showed a firm processing clients on essentially an industrial basis. Internal communications sometimes explicitly acknowledged questionable clients, but proceeded anyway. because the legal threshold for refusing had not been technically met. Real estate agents complete the picture. In the United States before 2016, real estate agents were explicitly exempt from the Bank Secrecy Act's anti-money laundering requirements. They were not required to verify the identity of buyers, report suspicious transactions, or conduct any due diligence on the source of funds in an all-cash purchase. A real estate agent could sell a $10 million property to an anonymous shell company without any legal obligation to ask a single question about who was buying or where the money came from. This exemption has been progressively closed since 2016, but implementation has been slow and inconsistent. Here is what makes Level 4 genuinely different from everything below it. At Levels 1 through 3, the laundering operation is separate from the legitimate economy. It uses the legitimate economy as a vehicle, but it sits alongside it, trying to pass through undetected. At Level 4, the laundering infrastructure is built into the legitimate professional services economy itself. The same law firms that serve multinational clients also serve clients whose money is not legitimate. The same accounting firms that structure the books for shell company cascades also structure the books for shell company cascades for legal purposes. And the same company formation agents that set up legitimate offshore structures for tax planning set up identical structures for money of criminal origin. And the crucial point is that the professionals doing this work often maintain what lawyers call plausible deniability. They do not know, and in many cases have deliberately arranged to not know, the ultimate origin of the money they are helping to move. They know their client. They do not know their client's client. They know the structure they are building. They do not know what will flow through it. They are paid for expertise in legal architecture, not for asking questions about what the building will be used for. This is not a defense. It is a description of how the system functions. And it is why prosecuting Level 4 operators is so difficult, because in most jurisdictions, the crime requires proof of knowledge regarding the criminal origin of the funds, and knowledge has been deliberately structured out of the relationship. And Level 5 is where I need you to hold two things in your mind at the exact same time, because they are both true and they seem like they should not be able to exist simultaneously. The first thing is this. HSBC Bank, one of the largest and most respected financial institutions in the world, with headquarters in London and operations in 64 countries, laundered $881 million for the Sinaloa cartel and the Juarez cartel between 2006 and 2010. This is not an allegation. It is a fact established by the U.S. Department of Justice, accepted by HSBC as part of a legal settlement, and documented in approximately 300 pages of federal court filings. The bank's Mexican subsidiary moved billions in cash through the U.S. financial system with almost no anti-money laundering controls in place. Tellers in Mexican branches accepted boxes of cash so large that the boxes were specifically designed to fit through the teller windows. HSBC's own compliance chief later testified before Congress that the failures were systemic and that internal warnings had been repeatedly raised and ignored. The second thing is this: not a single HSBC executive was criminally prosecuted. The bank paid $1.9 billion in fines, which sounds enormous until you learn it represented approximately 5 weeks of the bank's annual profit. The legal mechanism used was a deferred prosecution agreement, a device under which a company admits to the conduct described, pays a fine, agrees to improved compliance procedures, and avoids criminal charges as long as it does not reoffend within a specified period. HSBC's stock fell briefly and then recovered. Its senior leadership remained in place. It continued operating in every market it had operated in before. HSBC is not unique. Wachovia Bank, before its acquisition by Wells Fargo, processed approximately $378 billion through accounts linked to Mexican drug cartels between 2004 and 2007. Not 800 million, 378 billion. The fine was $160 million, equivalent to less than 2% of the bank's profit in 2009 alone. No criminal charges, no prison sentences, a deferred prosecution agreement. Deutsche Bank processed $10 billion in mirror trades between 2011 and 2015, a scheme in which Russian clients bought securities in rubles through Deutsche Bank's Moscow office and simultaneously sold identical securities in dollars through its London office, moving capital out of Russia in a way that evaded both currency controls and Western regulations. Fine paid, no criminal charges. Danske Bank's Estonian branch processed an estimated $200 billion in suspicious transactions between 2007 and 2015, mostly originating in Russia and former Soviet states. Investigations across multiple jurisdictions. No criminal convictions. You see, at level 5, something has happened that is categorically different from everything below it. At levels 1 through 4, money laundering is something criminals do using the financial system as a vehicle. At level 5, the financial institution itself is the laundering mechanism. The bank is not being infiltrated. The bank is the operation. And this creates a specific problem that regulators have never adequately solved. It is called too big to jail. The DOJ has acknowledged in internal communications, and senior officials have stated publicly that prosecuting a major global bank creates systemic risks to financial stability that prosecutors have to weigh against the interest of justice. If you criminally indict HSBC and the conviction disrupts the bank's ability to operate in certain markets, the downstream effects on legitimate depositors, credit markets, and broader financial stability may cause harm that exceeds the harm caused by the original crime. So the calculation is made, the fine is paid, the bank continues, and the signal sent to every other institution in the global financial system is clear and unambiguous. Laundering at scale, if done through a sufficiently large and systemically important institution, will not result in criminal prosecution. This is not a conspiracy. It is a documented policy position, and it is why level 5 laundering is, in the most literal sense, the safest place in the entire chain to operate. If you found this video interesting, please subscribe and turn on notifications because there is a lot more to come. Thank you for watching all the way to the end. See you next time.